fact, Diaman similarly ready for the invitation to take part at this QUANT conference. I will moderate this roundtable entitled Active versus Passive Approach. Let me introduce the speakers of this roundtable before beginning. From left to right, we have Diaman, Head of Portfolio Management at 1741 Asset Management, Mauro Grande, Head of Passive Investments Italy at Deutsche Asset and Wealth Management, Simone Rosti, Head of UBS ETF Italy, and Giancarlo Sandrini, Senior Relationship Manager at iShares. Just a little recommendation for the speaker, please 3 or 4 minutes for each question. Let's begin now that we have an intensive roundtable. The popularity of index-linked investment solution continues to increase, and the proof is the industry of ETF at the end of 2012 have more than $2 trillion. Giancarlo, do you think that after the growth registered in recent years, the ETF market will experience a pause?
During recent years, ETF have reached several milestones. Just to make an example, we recently reached the barrier of $2 trillion invested into ETF. The majority of these assets are invested in the US, which someone thinks that it's a mature market. But actually, the growth we see in the US is still very big. So we think that even if there is some people thinking that ETF has reached a mature point where the number of products will decrease, issuer will decrease, we instead think that the phase we are facing for ETF market is still a growing phase. So the reason is that the products the characteristic of the ETF products is very simple. It's a transparent product, it's liquid, it's cost efficient, and all the information regarding the structure of ETFs are available to all investors. I would also highlight one thing. The ETF is a pure democratic product because we offer the same option to a pure institutional clients, and the same conditions are applied to the single retail investors. So I think that the ETF is really the biggest invention in the financial market of the last 25 years. I would like also to highlight another number. It took roughly 66 years for mutual funds to reach $1 trillion. Instead, for the ETF, it took just 18 years. So the numbers are speaking for themselves. And we think that we will see a continued growth on the ETF market and also on the innovation of these products. We are also seeing an increase of clients using ETF. There is a research from Thomson Reuters and say that roughly in the last 2 years, the growth of institutional investors using ETFs is stable at around 9%.
Simone, from your point of view, how do you see the evolution of the ETF market in the next years?
Thank you and good morning, everyone. It's very funny because I've been in the ETFs market for 6 years now, and I've been always requested how do I see the evolution of the market. It's a market which is not yet a teenager in Europe, because it's still a 12 years old market, and it's a 10 years old market in Italy. So it's pretty new. It's growing. It has been one of the fastest growing markets, but it's still relatively young. What we have seen is that probably we have reached now the maturity point of the life cycle of this market, which doesn't mean the saturation point. We are still far from there, and I would agree with Giancarlo's point. What is changing probably is are the dynamics of the market. So we are seeing less concentration of providers. We are seeing more providers coming up to the market, both those offering a broad range of products and those offering niche products. So more choice and more providers for clients. On the product side, which I think is a good news, is that I mean, a lot of asset classes have been launched. Probably there are still some of them yet to come to be covered. Probably there will be new exposure which are not available right now. But what I think is changing is that it's becoming the production of ETFs is becoming less product-driven and more client-driven. This means there will be more products which are useful for clients and less products which are useful for us as providers to launch as a PR, as a public relation tool, which I think is a very good dynamic. And the other trend we are seeing is that clients are demanding the same product, I would say the same exposure, covered in a different way. So when we launched, I've been in iShares 5 years before joining UBS ETFs, and we have been visited a lot of clients, and every time we launched products, clients were demanding for other products or the product exposure in a different way. And for this, I mean, you launch a product in US dollar and clients request products which is Euro-X. And then you launch a distribution, a product that distributes dividends, and then clients demand for an accumulation product. So what is changing now is that there are providers like us, like competitors, giving the option to the client to cover the same exposure in a different way, which could be distribution and accumulation of dividends, could be physical and synthetic, could be hard currency and Euro-X. Or a currency hedge. And could be also, and this is probably peculiar to us as UBS, an A class and an I class. So I would say similar to the retail class and the institutional class, which is very new, and this is why Giancarlo forgot to mention that there is a provider that is actually providing an institutional, pseudo-institutional share class to the market. Which doesn't mean we are not democratic, because they are listed anyway. But I mean, apart from that, the demand for clients is for the same exposure, an exposure which is already in the market, but to be covered in a different way.
Mauro Simone has talked about new classes, more products. There is also the proliferation of different structures in the market. There are ETF, ATM, ETC, above all in the commodity space. And in our opinion, this aspect often confuses the investor. What's the reason behind that, in your opinion?
Well, that's absolutely true. We have been experiencing in the last 4 or 5 years the proliferation of different acronyms. ETF, ETC, ETN. What do they have in common? Basically 2 things. Are exchange-traded product, so product listed on exchange. Second, they just track the performance of the underlying. That must be an index or must be a single commodity for ETC. So, what's the difference? The difference is the legal structure. Okay? So ETF are funds, and especially in the EU, where funds cannot invest directly in commodity, and B, must have a minimum level of diversification. There has been an innovation that has brought other kind of product as ETC and ETN into the market. Okay, so What is an ETC? It's not a fund, it's a debt security. It's a debt security usually issued by a vehicle, and physical vehicle, I mean special purpose vehicle, okay? And usually physical ETCs are directly backed by the commodity, okay? So this means that as ETF, for the ETC, the asset is segregated. Because if the promoter of the product, as Deutsche Bank, for example, have some, some problems, the investors will not be affected because the asset of the SPV is completely separated, it's segregated from the asset of Deutsche Bank. Okay? So we try to come up with a product that is very similar to fund in this respect, but that is not a fund. The last one, ETN. ETN usually is issued directly by a bank. So it's not issued by a special purpose vehicle, okay? So it implies a credit risk. This credit risk can be or not collateralized. Okay, so if it's collateralized, then at the very least is less, then obviously the product is not collateralized. So as Deutsche Bank, we prefer to issue or to offer just two kinds of products, ETF and ETCs, because in our opinion are the most efficient and the less risky in the ETP business space.
Thank you very much. Much has been told concerning ETF market, but little about the criteria and techniques with which indices are built. Daniel, you have written together with Martin Gender and Thomas Pippen a paper entitled Regulation of Indexing Methods, Why Award Presentation Forgotten, that has overrides winner sharp indexing archival awards. In this paper, you have tried to categorize and analyze different indexing methods like traditional market capitalization index, or price velocity index, or fundamental cost index, and so on. In your opinion, should investors stop investing in indices linked to market capitalization, and is there a superior indexing method?
Thank you, and I'm coming to what I talked about before, and I also answer very briefly, and to answer would be no and no. You shouldn't stop investing in MCAP, and there is no superior indexing method, but you can elaborate on these short answers a bit. We are confident that the MCAP is going to continue to be an integral part of index investing. It carries a lot of advantages with it. Captures a lot of capacity, gives us a very good liquidity, tax efficiency, etc., etc. I think it would be foolish for me to sit here and say that MCAP is not going to be continued to be a large part of the indexing scene. However, we need to look upon the indexes a bit more broadly and don't think about MCAP versus the others. Because it's not the case that it is a fight out there which one is the best. Because at the end of the day, with any given strategy, they're all trying to capture different things. And the beauty of indexing is that, as opposed to some actively managed funds, if you say that we target some different risk return characteristics, we know that we're going to do that any given day of the year. If we set up an index that's trying to systematically capture a value premium, or growth premium, or size premium, we are sure that this index is going to be doing that any given year of the day. As opposed to perhaps an actively managed fund which says that they're a value manager, then autumn 08 comes, and all of a sudden value investing is not really performing well. Does this actively managed fund manager starts to have style drift, etc., etc. We don't know. It might not be the case, but it might be the case. And that is again the beauty of the indices. So, isn't there a superior index method? No, talked about before, they're all trying to capture different things, and they're all performing better or worse different market environments. So as long as we don't know what market environment is going to be tomorrow, which is probably as difficult to know, it is as difficult to say when stock market will be tomorrow. The stock market will go up, tomorrow will go down. We don't know if it's going to be a risk-on environment tomorrow or a risk-off environment. So the winner there is, as I talked about before, is really trying and get the concept of diversification into the investment mind when we allocate to indices. So instead of trying to say it should be MCAP or the others, it should be all of them combined. Trying to have a targeted and a diversified way of approaching different risk-return factors. I think so that is really the key here. But also just one last note that is closely related to this question is that as most of us still believe that MCAP is, let's say, the holy grail, we also always use MCAP as a reference point. We benchmark everything to MCAP indices. If we do style analysis, that we heard about before, market portfolio is always MCAP. And it can be a bit dangerous. We did some research on this topic where we said, what if we change the point of reference? Let's say we do a simple risk analysis, looking at the simple Power model, trying to disentangle from where the return comes. So we have the market factor, of course, and we have value or size. Normally, the market factor is always the MCAP index. And what actually comes out is that all of the other alternative indexing methods, they carry a value bias if we use MCAP as a market factor. And that is perhaps a bit strange considering the fact that I guess none of the alternative indices are really trying to, in an explicit manner, target the value tree. But what then did is we said, okay, let's swap the market factor. We don't use MCAP as a market factor anymore. We use an equal-weighted index as a market factor. And then we see that we can draw a completely different conclusion from that. All of a sudden, all these value biases of all the different indexing methods were gone. So what I'm trying to say about it is that we need to stop taking for granted that MCAP is the point of reference, and we need to draw a conclusion from it because it can be quite dangerous when we allocate to indices. That's just the.
In addition to this, from the new research of iShares, we note that offer the great and sophisticated investors always invest in active and passive investment solutions because this combination contributes to a better asset allocation mix. The study shows also that the majority of investors agree that the merger of actively managed and indexed will continue to grow, overcoming the antagonism between these two different styles. And Giancarlo, can an asset manager be passive and active in the same time?
BlackRock, just to introduce our company, because iShares is a brand, BlackRock is the asset manager of the ETF. So BlackRock worldwide have roughly $3.8 trillion in asset under management. So it's a leader in the investment management and risk management environment. And within these assets, we both manage active strategies and index strategies. Within the index strategy, we have iShares with over $800 billion worldwide and $150 billion in Europe. So we are offering both active and passive. And the reason is that clients are asking us to have products both on the passive side and active side. As you said before, we did a research last year, and the results were quite interesting because actually there is not a clear answer on how to use active and passive. We know that there are different benefits. When you use an active asset manager, you try to find out an asset manager which is able to add alpha to your portfolio. The usage of an index product is different because you don't want to deviate from your benchmark. So the difference is mainly this one, and it depends on how you would like to construct your portfolio. I would add also one thing, because we know that there is a lot of resources which are used for active asset managers. So you have a different portfolio manager, analyst, database, a lot of research, and it seems that passive is quite a simple strategy which easily replicable, but it's not the case. Index tracking is a difficult activity, and it involves a lot of economic of scale. It involves also index optimization, sampling. It's not simple to be able to offer to our clients several ETFs in several index strategies, from small cap to high yield, from emerging market US dollar to local emerging market in local currency. So in order to be an asset manager, in order to offer to our clients a complete spectrum of service, we need to be both active and passive.
Thank you, Giancarlo. Staying on this topic, Simone, how are your clients combining active and passive products in the portfolio?
Yeah. Thank you. Well, I mean, for me, the perspective is slightly different. In UBS ETFs, we just started, but we are almost only focused on institutional clients. So, funds of funds, discretionary portfolios, pure institutional clients, pension funds. So, my objective, and the most important thing to me, is to have the right index tracking tool for active asset managers. So this is the most important thing to me, and for clients, I guess. So it's not a matter of us providing, we do, I mean, UBS Asset Manager does provide both. But for me, looking after this business is the most important thing, as Giancarlo said, is to have the right index tracking tool. So we are focused on having portfolio managers being able to track very well the index. Having said that, we see clients using ETFs in a very broad spectrum. So we have on one side wrapped products like discretionary portfolios or funds of funds, which are using ETFs only as the underlying product. So they are focused on asset allocation. They select ETFs from a buy list, and then they implement the asset allocation through this tool. It's a new trend. There are some players having these kind of products. And then on the other side of the spectrum, we have clients not using or using very rarely ETFs just for niche products or for, you know, as a liquidity layer or things like that. Within this spectrum, there are several, I mean, I would say almost all the clients, asset managers, using both, I would say, ETFs or passive tools and active fund managers. The thing is how the client is, or how the client would like to implement his strategies. If he is more focused on fund selection, then the active fund managers component will of course, be the most important side of it. If the client would like to be focused more on asset allocation because he believes that returns come 90% from asset allocation and things like that, he will have a much higher component of ETFs within the portfolio. The two trends we have seen in the past couple of years is that less and less clients, especially in discretionary portfolios, are using single stocks as a way to implement their asset allocation, and they're moving towards ETFs and, of course, active managers. And ETFs becoming less the tool to access the markets, difficult to access markets like some niche exposures or frontier markets, and becoming more and more a core component of the portfolios. So using products, plain vanilla products like core equities or corporate bond or government bonds. So these have been, I guess, the two most important trends in terms of products usage in the past couple of years. But yes, I would agree, active in terms of fund selection and passive in terms of index tracking tool are, of course, part of different strategies.
Thank you, Simone. Giancarlo, in iShares, how are your clients investing active and passive products? There are some differences from the OBS approach that Simone explained before.
Well, there are a lot of similarity because we have maybe a lot of clients in common. Well, actually, the audience itself, I see a lot of my clients sitting on this audience today. So we should do these questions to our clients. How are you using ETFs within your portfolio? As you said before, we try to do this exercise. So last year we did a research with an interview to our top 35 clients in Europe. And there is not a clear answer. It's not black or white. There is not even a size, in my opinion, but it's more an art how to use active and passive. I think that anyway, in the future, investors should ask themselves in which occasion are you using active, or where do you prefer to use active, and where do you prefer to use passive products. Regarding some specific example, Simone, I think that Simone said a lot about some asset classes which are preferred with ETF instead of single stocks or active funds. I would add one more thing. In this environment where yields are so low, our clients are trying to find out new products for their clients where there is an enhancement on the return for their clients. So the thing is that there are a lot of investors which are switching to asset allocation products, and so in this framework an asset allocation product is a very well suitable product for ETF investing. So the thing is that you can also build a pure active portfolio using only passive products like ETF. And this is what we say to be active with passive.
Thank you, Giancarlo. Another big advantage of ETF is that they often give access to different asset classes or different investment teams that are not covered by mutual funds. Now, could you provide us some examples, please?
Absolutely. The first ETFs launched in Europe back in 2000, so 13 years ago more or less, had as benchmark very common indices as the Eurostoxx 50, the S&P 500, the MSCI World, and in this space there is a complete overlap between ETFs and mutual funds. So there are plenty of funds, for example, that cover the big caps in US. And the choice between active and passive is just a matter of investor preference, as well explained before, and also investment needs by the single holder. But in the last 5 or 6 years, we have been experiencing a real explosion in the ETF offers. And I can make several examples about products that have not a similar investment alternative in the fund space. As we look at equity, for example, we have really several ETFs that cover niche countries as Pakistan, Bangladesh, Malaysia, Indonesia, Chile. How many active funds we have out there that give exposure to Malaysia, for example? Very few. And in this respect, if a client if a client believes in that country, I want to give a bigger weight in his portfolio to that country, the only choice that he has is buy an ETF or buy the shares if he has the possibility to do that. The same in the fixed income space. If we just look at the govies, Deutsche Bank has 10 ETF that cover the Euro govies area because we launched specific ETF for every single bucket of the pool. So if you just want to, increase the weightings in govies that have a maturity between 5 and 7 years, or 15 plus, or 25 plus, I can do this with an ETF. So in this respect, ETFs can be considered the brick, the single brick that combined together can create the preferred asset allocation. That is the war. So I think that this is one of the main difference that we see between funds and ETF at the moment.
Thank you, Mark. Daniel, we have told before that as an ETF also in active index investment solution is more important how the underlying indices are built. From your point of view, are not alternative indices just active approaches in this wise, and how can you disentangle the ever increasing number of indexing methods?
I think the first question there is on not alternative indices just active approaches in disguise. That is the question that is very much hot to debate. But try to answer that one, perhaps just as a side note here, if we look upon the definition of passive, what is passive from a theoretical perspective? So basically, when we invest market weighted indices, is that the theory tells us that the market weighted index should carry the highest operation, long-term should be the most efficient portfolio. And if that is the case, then of course everybody should go into this MCAP index. However, as we had experience in the past, there's been a lot of research being published in this area, it's not necessarily true. MCAP in its theory doesn't really hold up to the test of reality. And also from there is this active managed funds in disguise. This question and discussion that is taking place, there is fight is taking place in the wrong battlefield. It really is less about what we label them. It's much more about what characterizing these indices. And because if you look upon how we construct and we make use of the word active and passive, I think how I like to look upon all these indices is that yes, I have an active view when I set the construction algorithm, when I set the index methodology. I actively decide to invest according to market cap, or I actively decide to invest according to book value. That's it. Or I actively decide to invest according to minimum variance optimization. And that is, per definition, an active decision. That is not a passive decision. However, what is passive? That is an implementation of the decision, active decision that I took. I think that is the main point that differentiates, let's say, what is commonly known as an actively managed fund, and one of these is a new alternative indices, is that the implementation is very much passive, regardless of if it's an MCAP index or a fundamentally built index. And then going into the second question, can you disentangle the ever-increasing number of index methods? It's very popular out there to think out the newest and latest and the greatest index method. There is a market for it. However, as we've seen also shown before during the presentation, they are all different, but there are a lot of similarities between quite a few of them. So looking at the details, you can actually then categorize them in these 5 different beta sources, covering everything from price focus to fundamentally focused, risk focused, return focused in this method. And that is then the building blocks that one could use when they're trying to set the indexing weights. And I think here, so last point to make here, when we read about these new index methods, so beta categories, etc., we really shouldn't be too impressed by what they're offering, because at the end of the day, they're doing what they're doing, and there will be no whole brain there.
Thank you. Simone, why SBS decided to relaunch the gas business?
This is the tricky question. You might have heard that in the past few months, UBS as a group went through a very tough and difficult exercise in terms of restructuring the offer. So basically what's happened is that the asset management and the wealth management component of the group had become more a focus than the investment banking component. So within that, the asset management part of UBS, which is anyway a 450 billion euro asset manager, had the investment to develop even more the passive components, which right now for UBS it's quite crucial because there are 120 billion of euro in passive management, and within that, of course, the ETF component is quite core, although there are still just 12 billion in ETFs. So basically, as a group, they realized that the demand from institutional clients for passive tools, ETFs and funds, is becoming more and more strong. It's becoming stronger and stronger, and it's following what's happening past 10 years in the Northern Europe, UK and Nordics and the Netherlands. So the passive component demand from clients is becoming stronger. So we have refocused our offer, and the ETFs, with the ETFs range, which was which has been there for quite a while, but never pushed outside of the UBS wealth management business, is becoming a core part of the new strategy. So that's why since last year UBS ETFs went out in the market. We listed products in LSE, in Citra, in Borsa Italiana in January, and the focus for us is basically to look after, to provide tools, passive tools to look after institutional clients. We leave retail to others. We leave retail to Lixor, which is doing a lot of advertising single products to retail clients, which is already becoming a boomerang. Sorry, Lixor, for you not to be here, so I'm going to stop here. We leave retail to, or the advisory side to those providers which have been in the market for quite a while, and we are very focused on institutional clients. So this then is reflected also in the offer, but I'm going to stop there, otherwise it will become a commercial spot. So.
Mauro, is the your experience are short on leverage ETF more used for speculative or hedging use?
There is not a univocal answer here. Short and leverage ETFs are absolutely funds, but the way in which they are used make them more similar to derivatives. So Deutsche Bank is at the moment the leader in this market space. We launched more than 20 short-term leverage ETF on equity sectors, also fixed income and so on. And what we have experienced is that it might be a surprise for many of you. While retail investors use this product mainly for speculative reasons, the institutional investors use short, especially short and double short, to hedge. And it can be a surprise for you also because institutional investors can use derivatives to hedge. Why do they use ETF? And the answer is very simple. ETF is more simple. It's more simple, especially on the administrative side, because you can buy a short ETF or a leverage ETF as a share. So if you look at, for example, the private mandates, it's very difficult from administrative side to input for the single accounts the position in derivatives. With ETS, it's very, very simple, because you just put the number of shares in the account of the clients, that's it. Okay? So, on the one hand, it's true that derivatives can be more efficient, especially as regards cost and spreads and so on, but it's also true that for some specific underlines, as for example short emerging markets and so on, derivatives is not efficient at all. So ETF in that space can be also a better alternative. I think.
To conclude, I have this question. How can sorry. To conclude, we have the latest question. How can investors access or benefit from alternative indices, and what strategies or instruments or vehicles, in your opinion, are available for the investors?
So if we look at the market for alternative indices, it's still very small as compared to the total market for indices. We first look at how we can access them, how can we invest in these indices. I mean, there are many ways to do it, and of course we can buy ETFs, we can buy index funds, but we can also buy synthetic exposure to these indices. There are a lot of index providers, the FTSE, MSCI, and stock trust worlds that are publishing indices, alternative indices. There's a wide array of these indices being published, and I guess every investment panel from Deutsche Bank to UBS, etc., they're more than happy to set up such structures in order to gain access to different kinds of indices. The benefit, talked about it before, the benefit is with the alternative indices that we can finally diversify. We can finally profit from the all-scale diversification processes that also are inherent in the indices space. We can do that two ways. We talked about before. We can do the central indexing fund. We go to Deutsche Bank or UBS iShares and say, could you please put together a portfolio of fundamental indexing, minimum variance, etc., etc. That's one way to go about doing it, and they provide great helps to do that. What we have chosen 74.1 is to apply the integrated approach. So we say we create one index instead of combining many of them in order to gain from these diversification properties. We create one index that we're trying to behave such as a diversified basket of these indices. And if you look at the last point, we look at the products out there. I think it's one of these reasons that there are a lot of products out there, but there are not too many either. I think the problem is not at the hands of, let's say, the index providers. I think it's more of the, actually, let's say, in the hands of US investors. At the bridge, we say the time for quantification is over. It's time that we also start allocating, and it's not only addressing the issue and talking about what can we do with the indexing space. Because all this, we as management, we're more than happy to offer solutions. And I think that is the main point we're talking about what we should access. It's not only the index providers that should come out with the full platform and offering everything, because that is not doable. There need to be money flowing into that area, and when that happens, all of these indices will be able to track through ETF, through mutual funds, equity swap, etc., etc. But I'm sure that is for sure something that's going to happen over the coming years.
Thank you very much, Daniel. Now I invite the next speaker of the Professor of the University of Siena, and thank you to everybody.